the key here is whether we have a divided parliament or a red sweep, or a blue sweep for that matter. So when you have the president with the support of Congress and Parliament at large, obviously policy can swing in many more ways and to a greater extent. So I would say that if we were to have a Trump swing with Republican control of Parliament, we'll see not only the trade tensions that the president can enact, even in the context of a divided parliament like we have seen last time, but also we'll have a more significant fiscal boost, which is something I think the markets might like when it comes to equities, and probably treasuries won't like.
Yeah. So, and again, I'll split treasuries, I'll split fixed income product and equity product up as well. Net for equity markets, is a Trump presidency a positive, a negative, or actually do the markets just do their thing regardless of the incumbent in the White House?
So I think it's a bit of both. On balance, I think it's going to be positive. It doesn't need to be as positive as with Trump. One, what we see with the first term of Trump was US equities, for example, rising more than 60% over the full 4-year period. But I think directionally, you're going to have tax cuts, likely a regulation cut as well, and that could be market positive. Of course, you might have also bouts of volatility, and they will come from the increasing uncertainty when it comes to the trade tensions. A bit of that you have seen over the past couple of days. You have seen market volatility, VIX first rising on the polls, changing from a low level, but rising nonetheless, and now have been down a little bit again.
Yeah, Daniele, when you take a look at what is supposed to be this rotation then that is happening in the market, is it actually still intact, or is there a case of the mega caps are the mega caps and they are still the more favored in this market?
Look, that's a very important question, and I would try to split this concept of rotation into there's two angles, two aspects here. So the first one is that when you look at valuations, obviously the mega caps, parts of the tech sector, not all, but I would describe it as having demanding valuations. And so you have seen with small caps, for example, but also with other cyclical markets, that whenever there is a sense that interest rates might decline more rapidly, the cyclical part of the market, the one that is more sensitive to interest rate changes, tends to rebound more strongly. Again, small caps is probably the most recent example. You have seen it with European equities before, and we have increased our exposure to European equities lately. So that's one angle. So the other one is that the market, even though performance is not as concentrated as it used to be, it's not just a magnificent 7. It has been driven primarily by some of those stocks, some of those names, and I think that has room to continue. And I would think that especially the AI-related stocks, I would almost look at them as a separate asset class, one that will follow a cycle as well, but is separate from the general market trend.